Hello. Hello, this is Eric Falkenstein. I'm going to be going over my particular IL minimizing AMM, or it's really a mechanism to help restore LPs to profitability. The IL is still there, we're just going to offset it, really. And the problem, I'm going to assume some familiarity with AMMs and how they work, but for LP positions as liquidity providers, they generally make fees, and everyone measures the fees very well, and they generate these APYs of 40+%. But you want to subtract the option cost, this IL, and the option cost is just mathematically built into the LP, the AMM constant product AMM, in that you have LP values linear in the square root of p, so it makes this green line concave, and you take the expected value of that, and it's just goes down the greater the variance you apply to it. And variance grows linearly in time. So here's your LP is a function of price change, or your IL is a function of price change, and you can see it's proportional to the price change squared, so it goes up with the square. And it's possible to get zero, but the expected value of this is going to be positive. And if you hedge it, you can turn it into this green distribution where it's here the expected value is 10, and you can instantiate a 10 by hedging it very well. And if you don't hedge it, you're still going to get an average value of 10, but it can range from 0 to 50 here. So that's the problem. And many other people have commented on this problem. Everyone recognizes that it's a problem, but even though they don't report the IL in and so we have current ones, we have historical ones. I went over those in my earlier video on this problem. Currently, the most popular, I think, solution out there that's getting a lot of traction are these, COW protocol and Uniswap X. They have these front ends that, they act like RFQs. I don't know if auctions might not be a bad word, but they put them up for bid, so they take in an intent or something, or in Uniswap X, you put in maybe a trade with a limit order, and it scours all the AMMs out there that it can reach, and it even scours private market makers, and they can step in front of it, and those are all fine solutions. They have their value, but they're not going to help LPs. They're just going to actually snipe all the juicy noise trades that are essential for LPs to make money. And so this isn't a long-term solution for unprofitable LPs. And in my SSRN paper, which I link at the back, and it's on this in this Substack post, I document that V3 capital efficient LPs lose money. Just to make a little pedantic point here. Impermanent loss is technically a specific realization of this loss, which can be zero and can be large. I use it to mean just expected impermanent loss, and expected impermanent loss is equal to your gamma decay or lever, but whatever you want to call it. So I'm just going to, when I say IL, I mean expected IL. The options literature has studied this for decades, and there's thousands of assistant professors with good articles on how gamma decay works whenever you have a convex function like square root of p. It's also called convexity cost and theta in that literature. In the AMM literature, it's more commonly known as loss versus rebalancing, but I think a better word for that paper would have been hedged LP P&L without fees. Well, that's a better description of what they're doing, but it's a mouthful. So anyway, whatever you want to call it, doesn't matter. You can derive it several ways, and that often influences how people like to call it. But in measuring IL, I go over this in my paper. You can measure it several ways. That is, they're all kind of like mathematically identical, assuming liquidity is constant. But and of course, liquidity isn't constant. Much more so for the V3s. And so for V2, it's really not a problem. Any of these methods work really well. For V3, but there are a lot of issues. I go over those, and those are a lot noisier estimates, but you can still do it. And unfortunately, very few people actually try to measure IL on these V3 because if you don't make some simple adjustments, you get wacky numbers. But it's doable, and so I choose the metric IL over fees as opposed to APYs or these markouts that are cumulative dollar amounts. Obviously, cumulative dollar amounts aren't scale dependent. If you have a large pool, it's just going to be larger in absolute value, and APYs are problematic because for V3 pools, which are that's the main target of our interest, because V2 pools, they make money fine, but they're very small and they're not growing. So APYs just depend on the LP's leverage choice. And it varies. You can have leverage differences of 50-fold. And so what does an APY mean? When leverage varies that much, like you're making an assumption about leverage. Normalized IL over fees, variable cost ratio. It's a stationary metric. If IL, which is a cost, if the costs are greater than your revenues, then you're losing money. And if the cost is less than your revenue, you're making money. So it's a simple idea. And so I measured these, and I've got data going back 5 years, and for the I got 5 V2 pools here, and on average they actually make for every dollar. This is the IL, the cost over the revenues is 0.6. So that means for every dollar they bring in, they basically make 40 cents. That's pretty good. So that's why they make money. Unfortunately, they use a lot of capital, so that's not good. But and for the V3s, most of them lose money, except for a couple. All the big ones do, and on average, it's about 16 cents on every dollar they bring in, they lose. So their costs are 1.16 for every dollar they bring in, and that's documented in my paper. So that's the problem we have to solve. And even if it wasn't losing money, if it was just breaking even, we like to make it better, and we can do that. So I actually looked at actual ARB data on 5 ETH USD pools. So they're the same tokens, and they're on the same blockchain, and the same AMM, Uniswap, and the data are from basically the last from April to through April of 25. And if I looked at those in the pools, and you can identify the ARB accounts by various tells. They have low gas usage, about 130,000 gas, which is much lower than you get through the routers. The routers, I mean, like Uniswap X and 1inch and things of that nature. Others, just I don't know who those guys are, but so your average trader just goes through a router, but other people, a lot of volume goes through these other. And the ARBs, you can identify them, and it's like 3 to 7 ARBs on every pool. Now, these are the P&Ls as reported from the perspective of the LP. So when I say the total, it means on average, this is the ETH USDC 5 basis point V3 pool. They lose 30 grand a day. Okay, and of that, how much do they lose to these various parties? And they lose actually 130,000 to the ARBs. So the ARBs are killing them. Luckily, they make a lot of money off these guys. Now we expect these to be the noise traders, right? Because they're going through these, they're sending their orders through someone else, so they're getting stepped on all sorts of ways. It's slower. So these are classic noise traders, the V3 pools all lose money. So the total P&L is negative for the total for the LPs, and they lose. The ARBs make money in all the pool. The ARBs, so the LPs losing to the ARBs means the ARBs are making money. It's a zero-sum game. The pool trading against the outsider. But the V2 pools, they're making money. And the ARBs make money, but the total, the LPs make money. So good for them. But it's good to know, for the V3 pools, they're like 60 to 74% of the volume. And for these much smaller V2 pools, it's more like 40%. So it's less. I mean, it's a minority, but it's still a substantial amount. The ARBs are pretty active here. And just so you know, the pools, what do they look like on average? If you just look at their prices every second, you'll see, for the 5 basis point pools, they're usually within 5 basis points of the Binance price. The 30 basis point pool, they're like within 30 basis points of the price. And And to the extent they deviate out, it usually doesn't last to the end of the block. If they go out more than, say, 10 basis points. But, so they're out episodically, 5 to 10 basis points. But more than that, that usually gets corrected within a block. So that's what we're dealing with here. And let me see if I get my... Okay. And the arbs are heterogeneous. So, here's a couple pools. These are both V3 pools. I call these the flagship ETH USDC pools because they've been around the longest since 2021. You have here I have like four arbs for each that I identified over this period. And, this is their P&L per day. And you can see that the averages don't quite add up because some of them are dropping in and out, and these are daily averages. Some of not all the arbs necessarily make money, so it's not super easy to do. But on average, the weighted average is they do make a lot of money. The simple APYs just take their P&L, and I took the net amount traded. So the average for this arb number 2 is on average. He bought or sold, net $8.9 million US dollars worth of Ether USD, and so I'd say, well, usually you need 3 times that in capital to be around. If your average plus or minus is 8.9, you're going to need 3 times that. So the simple APY here would be 56%. That's the $40,000 a day times 365 divided by this times 3. Okay, that's all I did. Just to give you a ballpark, So some of them are crushing it on the simple APY, but you can lose money. It's not a guarantee to make money. And then I thought, well, let's look at the after. We know that they pay in gas costs, and you can look at actually, well, how much did they pay? And what was their price? They all used about the same amount of gas in their contracts. These are arbs. They do very efficient contracts that, like I said, use like 140,000 gas per trade, as opposed to, you go through Uniswap X, it's more like 250 or something. But anyway, so the gas price is very, very quite considerably. This guy, he only pays basically nothing, 3, which is kind of like the median gas price on the Ethereum. And this guy's paying 114, which is just a boatload, and it's obviously killing him because it takes his net APY makes it negative, so that's not good for him. So anyway, they have obviously very different strategies in how they're doing this. Furthermore, you can see that this guy here, he's trying to be almost net flat at the end of the day, whereas this guy too, he'll accept some large volatility. But if I just aggregate them, the arbs as a group, and just ignore the heterogeneity, then you get the simple APYs here ranging from, basically the bad guys kind of like, they're going to be insignificant. So they, on average, the arbs make a good amount of money, the simple APY. And even if you add in gas, and then I try to add in transaction costs, thinking, well, if you gain $8.9 million, you got to trade out of that at Binance, assume it costs 5 basis points, which is very generous. And then just how much would those costs be? And it lowers it, by 20% for, this guy here. It lowers it by 50% for this guy here, for this pool. But anyway, these are still, arbs are making good money, net after all their costs. So they're all fat and happy, and they probably don't want anything to change. What are they doing? Well, the simple arb, basically, their objective is usually very simple. Every time they trade, they trade up to the fee and price. And so, if the fee is 30 basis points and you see the Binance price is 101, current price is 100, you're going to push the price up from 100 to 100.7. That's the profit maximizing trade. This edge is how much you push the price. I call it the edge. But in your fill price, it's going to be basically the middle. It's going to be the geometric mean of P0 and P1, but it's at this scale, it's basically the arithmetic average. So, and so why are they doing that? Why are they just simply following the Binance price? And it's because centralized exchanges, they operate under 10 milliseconds. They have co-located servers. They're operating very quickly. Now, decentralized AMMs, it has to travel across a significant geographic region to be considered decentralized. So you can't just be in somebody's, a server location in Chicago, like for the Merck. And further, you need a consensus mechanism. So at a very low level, for as long as it's decentralized, there's a lower bound of 250 milliseconds on these decentralized AMMs. And it'll never get within an order of magnitude of the centralized exchanges in terms of latency. And that just means that for liquid coins that trade on both, it's just always going to be the dominant strategy for the ARB to just look to Binance and Coinbase. And it doesn't take the kind of alpha you see in traditional markets where you're trying to predict Apple, but nobody, there isn't an obvious signal. Here, it's the DEXs are the tail and the Binances are the dog. So it's that sense it's trivial, but it's not trivial in the sense of there's only a handful and they're making 70+%. So obviously, the other stuff, getting the APIs ready and whatever they have to do to connect to RPCs efficiently is non-trivial, and risk management. But that's what they're doing. We know what they're doing, following the Binance. So you can set up an ARB to do this, and that's important. And they also, the ARBs are being very opportunistic. Actually, we have a couple of redundant AMMs on ETH. If you have a 5 basis point V3 pool, like why the heck is anyone trading with the 30 basis point one? Well, you get some crumbs. Aggregators like UniswapX will send you there if their prices are out of whack, but it's basically kind of a dead pool. And the ARBs they're doing a lot of their trades just back running dumb retail pools. So basically, what I did here was I looked at all the ARB trades that were done in a block after a trade that moved the price by, say, 15 basis points or 5 basis points for the 5 basis point pool. And then I said, well, what was the P&L for those trades? Now, this happens like 10% of the trades for these ARBs, so 10 to 15% of the time. And for everything but this, the big dog, the 5 basis point V3 pool, it was significant. It was most of their profits, basically, by far. It's just picking off dumb traders. And this isn't the bad, it's not like a sandwich attack where you're abusing somebody. If somebody pushes the price 10 basis points away from the current SEX price, and the ARB pushes it back, good for him. He's doing his job. But you have to remember, pushing that back, it doesn't affect really IL because it would get pushed back eventually, just by the aggregators themselves in a clumsy way. But so they're making a good point. Here's the gross profits. Gross profits is net profits plus fees. This is basically all the profits, the gross profits that the ARBs are making. And for these, for 3 of the 4 pools, it's from 130% to 190%. So they're making a lot of money, clearly not just off IL. Now, theoretically, if just the ARB was trading against the AMM, he would make 100% of the IL if he had no fee. And his gross profit would be 100% of the IL. All right, if it was just one trader trading against, an LP. But so clearly they're making money off of stupid noise traders, and that's good. That happens on centralized exchanges too. Making money off of stupid trades is part of the profits. Just like if you're selling alcohol, a lot of your profits come from alcoholics. So that's just nature of the beast. But for these less these V3 pools, 30 basis point V3 pools, they're not even their gross profit is not even covering the IL, which it's interesting because it means that the aggregators and the noise traders are effectively doing some price setting arbitrage trades in their clumsy way because UniswapX sends their trades to the lowest fees. But so the important point is they're not just making money off of IL. Their gross profit. They're making money off of noise traders. That's a complementary skill and activity. And that gets into, we should expect the ARBs to collude because they are, and they do, and they have in TradFi. There's a famous case of, what's his name, Christie and Schultz came out and they showed that NASDAQ, which is a regulated market where you have no anonymity and you have legal ramifications, they were able to collude with 60 dealers in a dealer market for, I don't know how long the dealers were doing this for, but at least 5 years. And so they looked at comparable market cap stocks, and basically the spreads would be 2 to 3 times higher on NASDAQ than they were on the NYSE, where they didn't have a dealer system, they had a specialist system. So in theory, this shouldn't have happened, and nobody predicted it. But this Christie guy, just dug it up and found it. And it's an interesting story. Once it was reported in the press, the very next day, the spreads collapsed. So this is just like one of the better empirical finance pieces ever. But it just highlights large groups of traders. They're sneaky. It's you're dealing with Jordan Belfort mixed with SBF. So here, my solution is based on integrating the ARBs into the AMMs. Because there are a few ARBs, and why does this happen with open entry? Well, you have a power law distribution and everything. Even though they don't have true alpha in the sense of, whatever the Warren Buffetts of the world can do, you still have a power law in ability, just like, power law ability in everything from like pickleball to wrestling. So you're always going to, at some point, their skill is going to be so much higher than everyone else. Whenever you take the right tail of this just power law distribution, these guys are just going to be way out there compared to your average guy. So, everyone wants to make 50% like the ARBs are making, but, it's non-trivial. Even though it's trivial to my objective is just to update to the Binance price minus a fee. But actually setting that up during the risk management is non-trivial. And because it's a few ARBs playing a repeated game over and over, you get from the prisoner's dilemma to tit for tat. And so that's, there's a strong mechanism for them to reach the cooperative equilibrium as opposed to the competitive one where they're competing against each other. And in perfect competition, they would make zero profits. And we know that there are chances for all sorts of opportunism high, which makes auctions and things of that problematic because they're going to play games, and I think it's better just to pull them in and just align their objective to maximize profit with yours. It's a way to eliminate a lot of the problems generated by just putting something out to bid, and then they can do what they want. But and then there's an interesting thing if you pull them in. My solution is based on when levered, both the LP and ARB, when they're both levered, they develop these needs to rebalance their positions, right? Because as you're levered, at some point you're going to run out of one token and have a surplus of the other. And because ARB is trading with the LP, they're going to develop surpluses and deficits that offset each other. And so obviously there are gains from trade that can be made there. And as mentioned, since the ARB service is straightforward, we know they're matching the Binance price. I mean, even though you got to be skilled to do it, it really doesn't matter if I pick you off here or here. Setting up APYs and understanding how to do that, connecting to the blockchain efficiently is straightforward enough that these ARBs really don't have negotiating power. So if those guys making 100% say, screw you, I'm going away, well, fine. There's going to be 1,000 people who will step up and take a lower, a 30% return on capital, which is, I think, eminently doable. Now, the specifics for this, this is a constant product AMM, is that the LPs and ARBs get margin accounts. So that is, they have leverage, same thing. So they have debits on their accounts. And obviously that has to all be on chain, and they can't withdraw, until they plug all their debts. So they have margin accounts, give them leverage. The LPs to make them capital efficient in the context of a V2 AMM. The ARBs, we want to give them leverage too because we're going to take so much money away from them that otherwise it's hard to generate attractive returns on capital for them. Remember, they're just going to set up an arb bot. It's going to be automated, just like high-frequency trading is. You write down a program, and there it goes. You're not sitting there clicking any buttons. So once you set it up, it's basically got no fixed cost, it's got no marginal costs other than the electricity, which is not like running a mining. It's just trivial. Setting it up is not trivial, but running it, the variable cost is going to be small. So it's going to be easy, but if we didn't give them leverage, they'd make whatever. They would make well under 10%, and then you're like, I don't know, are people going to really show up for that? The LPs and ARBs are going to swap collateral. I mentioned, they have this complementary collateral need that they're going to develop as the price changes. So in this, the cool thing is, by levering the V2 for the LPs, we can get the same capital efficiency as V3. You're not going to get 100 to 1, or you could, but then it would just be insane amounts of liquidation risk. But you can give them 5 times leverage, and then you're not going to get the race to the bottom that you get in V3, where these guys it seems just to generate the bad effects in V3. Obviously, there's a mechanism there that's destroying them because it pushes people to always put in just a little bit too much liquidity. And then the key feature is the ARBs get 0 fee, but they only get to keep 10% of the P&L. The rest goes to the LPs. That sounds horrible. Well, it's better than nothing. And hedge funds, generally give, their PMs, especially starting PMs, 10% of their P&L. I worked at a hedge fund several years, and that was, my take. 10% is often even lower than that. You're willing to do that because you can get more capital. You can get more, they give you these front ends. So they give you things, and are you willing to give them 90% of your P&L? Yes, you are, because where are you going to get that capital otherwise? You can get $1 billion in capital, or notional. You can get $100 million in capital, and for your average person, you're not going to have $100 million to put down. So, it's a good trade. And another interesting data point I just ran into earlier this week was that Chainlink provides a low latency service to one of GMX's, to GMX for 2% of the GMX's protocol fees. So that's like paying your ARBs who are just updating prices 2%. If we think of the fees should pay for at least impermanent loss, then that's obviously much less. Of course, that's not a good solution. It's got a lot of, I spoke about oracles before, but anyway, 10% is not, it sounds horrible, but as I'll show you, the ARBs will still make money. Maybe not the current ones, someone else will. And here's how it works. The 5 times levered LP looks like this. Let's just a standard V2 pool. We've got 100,000 in ETH and $100,000 worth of USD. They have debt 50,000, and so this is 5 times leverage. So that their net is 1/5 of these amounts. So they have $40,000 in a V2 position worth $200,000. Now the ARB is 5 times levered, but he doesn't need the V2 amount. He just needs enough to push the price, say a 10% move up and down, and to do that he needs 5% of V2 capital, because to move the price up, or down 5%, if you want to move the price up 5%, you need 5% of the USD of the V2 token amounts, and he put that into the pool, and then he'd get 5% of the ETH out, and then the price would move up 10%. So let's just say he shows up, but because he's 5 times levered, he doesn't need 5% of the capital. He needs basically 20% of that, which is 1% of that capital. So that's how that works. As far as liquidation, because they're leveraged, you should start with liquidation. How are we going to determine when these guys get liquidated? And for the LP, the pressing constraint isn't bankruptcy. That is, he's 5 times levered. This is the same liquidity. This is a standard V2 LP pool in value. And then with your 5 times levered, you start off, you're at you're at 20% of the value. And then as the price goes up, eventually the LP is going to go bankrupt at plus 30% and down, 67%. It's the same in log space. But anyway, big moves. This wouldn't happen overnight. Obviously, this would be probably a year or two, or a crazy year like 2020 or something. So that's the bankruptcy risk. The more pressing risk is actually just running out of your token. So, if the price moves up like 60%, he's going to run out of ETH. And then if the price goes down, I forget, it's like 36% because everything's equal in log space, log chain space. But so if the price goes up 56%, the LP is going to run out of money, and that's what I show here. So here the price goes up like 60%, and what happens? The LP now just has all USD, and he's just basically down to zero in his ETH, and so he's not. So that's going to and the value of the position actually is going to go up in this case. So you might think, oh great, it's solvent. I'm like, well, yeah, it has enough value, but you don't have any ETH, so no one can trade. So that's a problem, and that's going to be the binding constraint for the LP. That's his default metric. For the ARB, it's just more traditional. We're not going to give him debt instead of just standard margin account where you can show up and have positive amounts, but you can have a negative position, a short position. Here I haven't read. So if he starts out with, this is 1% of the V2 capital. Here I just model it as, I'm just modeling him. If you model an ARB trading against an LP and he's the only ARB, he never loses money because he's just trading, against, he's just going to make money off of that IL that has a minimum of 0. But in real life, the ARB's going to trade and he might be inattentive. He might, in this example here, it starts out 2,000. He pushes the price down to, he pushes the price down like 36% to 1,279. Big short position in ETH because he sold it. And then, he goes on vacation for, a couple days and the price goes back up, 15%. And now all of a sudden he's just about to default because his short position just got wrecked. His short position increased. So you need a liquidation procedure for that guy too. And okay, fine. That's doable. But notice these are pretty big moves, 5 times leverage. Now, as for the collateral swapping, it works like this. On average, noise traders by definition don't have net demand. Now, on average. So day to day, yeah, it's going to be there. But on average, when a pool loses X amount of ETH, the V2, he's levered. Now the LP's got a fixed amount of debt, unless they change it, or it's changed explicitly. But just due to prices changing and our trading, the debt's going to be constant. So that's not changing. So if he loses in the pool X amount of ETH, that means his net ETH goes down by X. And then where did it go? On average, it means the ARB gained X amount of ETH. And vice versa for USDC. So there's obviously, gains from trade there because over time you're going to have to rebalance your pool. And if you run like these restricted range pools, you realize as the price moves, you got to, withdraw and then redeposit, and that's a pain. And if you're the ARB, you got to go, you got a lot of ETH, you ran out of USD. If you didn't have leverage, you'd have to withdraw your ETH, take it to Binance, sell it for USD, and then bring that back. So I want to minimize those things, and this is what a collateral swap would look like. In this case, the price fell from 2,000 to 1,200, wiping out all of the USD for the for the LP, so he really needs USD. The ARB, on the other hand, he's got a big short position in ETH, and he's fine. His total value is well above his required margin, and so he's safe. But the LP really needs to rectify their absence of USD because there's no USD in the pool at this point, and we can make a trade. And so the threshold condition is, well, we want to have it to be a significant size. We don't allow to do this every tick because there are little games you could play to game the system, but that's just a technical point. So you might have a balance of, the LP net balance has to be greater than X% of the pool for you to do this. You're not going to do it on minor things. And then it should be mutually beneficial. So in this case, there are mathematical ways to figure out, if he's short ETH and this guy is has excess ETH, well then hey, we can do the trade. So that's what we do. We figure out the ETH excess for the ARB. He has a negative ETH excess, and then figure out the ETH excess for the LP. He's got an extra 11.25. So you transfer them around, and then boom, we bring the LP back to being having symmetric token balances in his net token balances, and you do that by just adjusting the debt for this guy, and then you have this in the for the ARB account. It doesn't take him exactly back to even like you do for the LP, because the ARB started with smaller amounts of both. But it kicks the can down the road quite a bit in terms of them having to go out and do things off the contract, and especially off chain, which is annoying. And these transfers don't affect the value. So after the transfer, the net value of the LP and the ETH are the same, and the liquidity of the pool is the same. So this is all just kind of like a technical point, but it does simplify their, reduce the complexity and these off-contract costs. And you can see this in this little graph here, without collateral swapping, the LP would run out of money after a plus 60% move. With this, basically it goes on for a long time. So 60% move would happen, say, 6 times a year. And then this thing's going to push it out to every, year or two. So considering your average LP's in there for, a year or two, it's going to be infinite for most people who start here. And for the ARB, it's a lot more impactful because if they show up 1% of V2 capital to trade, they're going to run out of 1 or 2 tokens like every day or every other day. And in this case, you push it out to, well, now you're going to run out of capital every a couple months, and then you'll have to take something off and go to Binance and do something. But from moving that to something that you do, every other day or every day to every other month, that's a big simplification of your job. And that's what we want to make. We want to make their job simple. You turn on the ARB bot, you put in your money, boom, and then it just goes, and you're not having to go back every day and talk to your Binance guys. And so what are the, how can we be confident that this, it's going to still be attractive to ARBs? Well, you can just do a standard high-level pro forma, which is we know the IL, our profit, is going to be about the daily. It's the variance over 8, right? There's that formula from the Lever guys, and for Ethereum, it's 3.6% daily vol over the past 2 years, and so 3.6 squared over 8 is like 5.6. So 5.6 in our profit. The ARB profits, that's the juice that the ARBs should be able to, the IL should equal the ARB profits. They're different sides of the same coin. That is, the ARB should make that gross, including their fee. But here he's not paying a fee, so he gets the 5.6%. Add some noise, because we know that the ARBs do make money off the noise. So let's just add 25% noise, bump that from 5.6 to 7%. So he's making 7% of V2 capital in ARB profits. And there's no tax yet. There's no fees. And what's their capital? Well, they're going to need 1% of V2 capital, as mentioned before, because they get leverage. They would need 5% of V2 capital if they didn't have leverage, but they have leverage. So they can get away with 1%. So 7% divided by, or 7% of the V2 capital divided by 1% of the V2 capital is 7 or 700%. Well, that's a huge rate of return. We let them keep 10%, boom, we're at 70. And that's obviously, you're going to be able to find somebody who's willing to do that. So that'll be okay. And if we look at their actual data, if we just look at their, look at these ARB collectives and take the net P&L plus the ARB fees they do times 10, and just look at how much they're all fine. Yeah, the current way they're making, these are slightly different numbers because I use different samples, but anyway, current ARBs are making in this measurement 30 to 99%, because I assume that the existing ARBs are unlevered, so they have like 5% of V2 capital. I just made that assumption for the ARB collective, as opposed to looking at the APYs on individual ARBs. And then the proposed rule would give them 5 times leverage. So they're going to make less money. So currently the ARBs make $130,000 a day on the big dog. That's going to go way down to $21,000 a day, but they get 20% less capital. So they're still going to make a decent return across the board. So don't feel bad for the ARBs. And if you do, there's someone else who will take their place. Now for the LPs, this is where we really want to see, does this make any sense, or can they make money? And for the big ETH USDC V3 5 basis point pool, they lose 30 grand a day over this period where I had the ARB data. And if just as a percent of V2 capital, which I know isn't what you use in V3, but just to normalize it. So they're losing like 1% of V2 capital. Interestingly, the other V3 pools lose about 1% of V2 capital. But they're losing, and the V2 pools are making 3 to 5%. Not bad for passive money, actually. With the new rule, where the LP revenue is basically 90% of the ARB's net profit, as I measure it, and the fees that those ARBs paid, because that's their gross profit. And so that's going to be the money they get off of the ARB traders. And then they'll still get the noise trader fees. The noise trader fees, they'll be paid as, so this is all revenue here. And then you subtract off the IL. And then we get numbers like this, where the big V3 pool, you take it from negative return on V2 capital. This is the return actually on the 5-to-1 level. And this 11.4%, this is just applying the new rule to the world, and assuming the ARBs didn't change their behaviors. And we should expect the gross P&L for the ARBs to go up when they optimize their tactics for the new fees, and so they should only do better. It kind of falls out of the envelope theorem or something, but now it's not necessarily going to make every pool profitable. However, these two smaller V3 30 basis point pools are they're losing money now, and even with the the capital, 20% of capital, but they're still going to lose money. There just isn't much noise trading on these things, as you would expect, because they're 30 basis points and V3. So if you're a noise trader, why would you pay the 30 basis points? So it's not going to save. You still need you still need a good amount of noise traders to make money, and in these cases, the ARBs, the ones that I had anyway, were their total gross profit was significantly less than the IL. So anyway, it's not. This is not a panacea. This is not going to be a way to automatically make money for LPs, but it's going to make it a lot easier. And for the existing ones that make money, it's going to make them much better. They're going to make it actually increases their profits a little bit, but they're going to save on capital, so they do a lot better in this situation too. And just some final thoughts. You can do things to make their lives easier. We don't want cutthroat competition that causes a lot of instability among the ARBs. So once they prove their worthiness by getting in the tail and dominating, and putting in minimum trade sizes would be good to prevent one of them from trying to penny the other one all the time. So you said, well, you can't do a trade unless it's at least 5 basis points. That would be a good rule. And combined with the rule that the fee is 10 basis points or something, then that would just totally allow them to dominate the non-ARBs in terms of picking off noise trades and also picking off the price setting arbitrage from SEX price movements. there's no reason the fee should be 5 basis points given front ends are charging 15 to 50 basis points. It costs at least, even if you're an institution like AQR and you're trading Apple, you should expect to pay 5 basis points trading Apple. So why should we have like cutting edge fees for this risky Ethereum and in this crazy decentralized environment, especially when front ends are picking off extra fees? It just doesn't make any sense. So this is 5 basis points is just a silly price for a risky asset. And then you probably want to put a gas price limit. That would be easy to do. You don't want the arbs competing on gas price because then that profit just goes out the door. It goes to the sequencers and validators. And it's interesting to note that the leverage does create an use case for equity because you're probably going to want like some sort of insurance fund just in case. So now, yay, we finally have a use case for our equity. Once you have leverage for arbs, and you can extend that to traders in a pretty straightforward way. You get perps, so that's nice too. And even if you're a centralized place like Robinhood or Coinbase, Base has got a lot of activity. They're centralized, obviously, but there's a use case for Coinbase. The nice thing there is you can trade on chain and not go off chain. That's often desirable. So it would still be somewhat centralized, but it'd be more secure and transparent. And so, they might find this attractive. Obviously, they could modify it by, by just say owning the ARB bot themselves and running it. Maybe they wouldn't want to do that, but maybe they would. But anyway, it would be a way to have a profitable AMM on their little world that's not, totally centralized like Hyperliquid or DYDX, but it's it's on their chain and it's more transparent. So anyway, thoughts, questions, criticisms, just put them in my comments and appreciate it. Thanks.